Welcome back to Squawk Box. Earnings season right around the corner. Let's talk markets now with Emily Roland, the co-chief investment strategist at Hancock Investment Management. Emily, good morning to you. We're pretty much at record highs in the S&P 500 as well as the Nasdaq's. That's a terrible setup or a very difficult setup going into earnings season. Where do you stand on this rally in general in terms of the strength of it?
Yeah, Melissa, there's a lot of things going right from a technical perspective. You mentioned new all-time highs for the S&P 500. We're seeing broader participation from sectors like financials and industrials. That's really, really healthy here. We're also seeing sentiment. It's turned from pretty deeply negative to positive, but there's likely still some room to run here from the sentiment perspective. Then we move over to the fundamental side of markets and economies. The economy's in decent shape. That's been evidenced by positive labor market data that we've received. Corporate defaults remain low here, and earnings are very, very healthy, especially as it relates to the S&P 500. So there is a lot of things to love about this market. I would say the only challenge here, the only risk in markets is there really is no risk being priced in. The S&P 500 is now trading at 22.3 times forward earnings. That is near the 10-year high. High yield bond spreads at 268 basis points, very close here to 10-year tight. So markets are pricing in a lot of positive developments that is being supported by the fundamentals. But as you mentioned, we're just sort of at a tricky point here heading into the back half of 2025.
What's your biggest worry about the markets then? I mean, as you take a look at it, it seems like the markets have become a little bit inured to trade headlines at this point. We've got the tax cut extension. So policy-wise, we're on a good track. What's sort of that outlier thing that could take the markets down?
Yeah, I mean, I think, as you mentioned, there's been a lot of things going right as far as the passage of the bill and markets responding positively to that. I think, markets are tending to expect that tariffs are a negotiating tool and are certainly not kind of repricing worse tariff risk here. So there is a lot of good news in markets. I think, hopefully we can turn our attention to earnings season here and markets can move past some of these political developments. It's really hard to handicap those geopolitical inputs into markets. So hopefully we can move on here to profits and earnings. It sort of reminds us of that famous Bill Belichick interview where he said, we're on to Cincinnati, and he wouldn't really answer any questions about the game, meaning that the next game is the most important one. And that's what we're looking at for earnings season here.
Yeah, it probably didn't end well for me. I can't believe you picked that city. Emily, you've been...
That's my hometown.
Oh, it is?
Yeah.
Did we talk about that? You're an East Side person. You're an East Side person.
No. I'm a Boston girl, North Shore.
Oh, what did you say? Oh, that's your hometown. I thought you meant Cincinnati. Yeah. If you were from Cincinnati, you'd be from the East Side. That's the better side of it, and I was not from there. Not that I grew up in squalor, and that's not what I'm saying. But you've been kind of chill about these things. You are the anti-Fred Kemp that we had on a little bit earlier. You have thought a lot of this is like, just relax on some of that, especially bonds. You think that bonds represented a lot of value. You have to, finally, in your world where you have to have money has to be there for a lot of people that John Hancock do business with. So it's different. But you've always thought that you didn't think the bond market was going to implode from this bill, did you, or from anything else?
No, because, Joe, there's something going on underneath the surface that you and I have talked about, which is significant disinflation, especially coming from the housing market. Shelter represents about 2/3 of CPI readings. That's incredibly important. Yes, there may be an inflationary impact on the good side of our economy that comes from tariffs, but service is a much bigger driver of inflation readings. We're seeing the biggest supply of housing since 2020. We're seeing demand starting to slow in the face of unaffordability and untenable insurance costs. People a little bit more worried about their labor market prospects. So there's big changes happening on the housing market. And we think once real-time measures of housing catch up to CPI, you'll see us hit the Fed's inflation target here, and they'll be able to resume cutting. So we don't see the potential deficit increase really creating a ton of volatility around bonds. We see that disinflation from housing actually being the more important element here, meaning there's a lot of value in bonds at elevated rates. Bonds are mispriced. They're not sniffing this out, where stocks here are relatively priced for perfection.